Welcome to the Multifamily Investing Show, your source for market forecasting, investment, and operational strategies. Your host is Michael Becker, a principal at SPI Advisory and a Dallas-based multifamily operator who has purchased over 10,000 apartment units and manages over $1 billion in assets. Join us as Michael interviews the top players in the world of multifamily brokerage, investment, financing, and economics. And here is Michael Becker.
Welcome to the Multifamily Investing Show with Michael Becker. I'm Michael Becker. We're here for episode 4, and I'm real excited today to have my good friend, longtime friend, Nick Fluellen. Nick, appreciate you coming on.
Thank you for having me.
Yeah, Nick Fluellen's senior managing director for the Fluellen Hoover team at Marcus Millichap, based here in Dallas, a few miles away from where we're talking today. So thank you for coming in on a rainy, cold day here in Dallas. Maybe just give a little quick background on yourself, Nick. I know we've known each other a very long time. Kind of came up with the business around the same time. Maybe just give a little brief background on kind of you guys and what do you guys focus on?
Yeah. So I went to Texas A&M and decided to stay in school and get a master's degree in real estate finance, basically. And so straight out of that program in 2004, I started Marcus Millichap, and that was a great time to be starting in the multifamily business. It's funny because, it doesn't seem like it was that long ago, but the technology has evolved so much in that period of time. But I mean, at that time, we weren't even doing e-blasts. We were doing fax blasts. And I mean,
you would literally fax your listings.
You would literally sit and type in 1,000 numbers in a fax machine and send like a little one-page flyer and then push go and listen to it dialing all these numbers. I mean, so pretty remarkable, shift in technology.
Yeah.
Nobody had a GPS, nobody had anything. I mean, so we were looking at rent comps on a Mapsco and trying to drive around and figure out where everything was at. So
you still remember the grid number for South Irving? Where you probably sold
you know what? I've long forgotten that. But at one point I could have probably told you all kinds of weird things like that. And so anyway, it's been a lot of fun. We started off doing any and every deal we could get our hands on, and have grown with clients over the years, and didn't take long at that point in time to start getting into kind of 100+ unit stuff, and obviously over time the deals have gotten larger and the values have gotten higher, and so been really fortunate to be in the same place now for coming up on 17 years.
Wow.
And grown a big team, and my partner Bart Hoover and I have 17 people on our team, primarily focused on Class B and Class C and DFW of all sizes. We have a segment that focuses just on 75 unit and under deals, which we love, kind of getting to know investors as they're doing their first deal, and then hopefully to keep growing with them as they get larger and larger over the years. And then our biggest opportunity, I would say, or an area we're really excited about has been in secondary markets. As DFW has gotten so hot, we have a number of people that are frustrated because they can't win deals, or they don't want to win deals at the prices they're trading for. And so to be able to take them and put them in some different markets is something that we've really spent a lot of time and resources on, and are seeing a lot of success in that area.
Yeah, so I went to your website to kind of you have a pretty good website with some history, and it's multifamilyadvisors.com.
Multifamilyadvisors.com. Everybody always asks, how'd you get that? I was like, well, that's because nobody was on the internet back then. I bought it a long time ago.
That's right. So Nick does a pretty good job of tracking his history here. So I went through a little history lesson. So you started in 2004. You did $5 million in sales your first year in business. Was that a full year or partial year?
2004 was about a half year.
About a half year, okay. And then you peaked out kind of pre-Great Recession in 2017 at 115 million in sales. Hit the trough in 2010 because that was the worst year, was 2010 at 43 million. And what did you guys do in 2019, and kind of where do you see 2020 finishing out?
So yeah, I think 2018 we were right at about 500. 2019 maybe a little bit less than that, and that can ebb and flow. Of course, just depending on what deals you do. And then this year we'll be over 600 million. I don't know. We'll see if we get to 650, depending on what closes. So yeah.
So from 5 million to 600 million in about 16 years.
Yeah, and of course the size of the team has certainly grown. And quite honestly, the same deal that we were selling, back in 2004 is probably worth 3 or 4 times,
Sure.
in some cases more what we were selling it for back then. So yeah, a lot of different factors, and I'd like to think we've gotten a little better at what we're doing overall this time. So yeah, it's we've done about $3.5 billion in that period of time. Very little of that is portfolios too, so that's pretty much all on a one-off basis. That's 500 plus transactions. So yeah, it's been a wild ride.
Seen a thing or two. So
Seen a thing or two.
So I think what we really want to focus the bulk of the conversation on today is really about the evolution of workforce housing, kind of what you talked about. But maybe before we get into that, maybe just talk about like the drivers. So you focus on not only Dallas-Fort Worth, but now really a lot of secondary markets in and around kind of the North Texas region, and you've even done stuff in New Mexico and Louisiana and Oklahoma. So kind of
Kansas. We've done some deals in. Want to do more in Mississippi. So yeah, we're really all around Arkansas. We're working on a handful of deals in Arkansas right now.
So what's really driving people here to kind of our region, but maybe talking a little more specifically about Texas and Dallas-Fort Worth. What is really the drivers in your mind, and why is capital coming here? What is your questions that you get asked when these people are first coming to town? Why are they here?
Yeah, well, I think, of course, a lot of folks from California have come to DFW, and that's been the case really my entire career. I think we had a little period of time where the local investors, and still that period is probably going, where local investors are far more active and there's more of them. But I think, we're a very business-friendly state, very landlord-friendly state. We are attracting a ton of new companies. A number of big Fortune 500 companies have relocated here. Charles Schwab, AT&T, Toyota, State Farm, PGA, and the list goes on and on. There are literally hundreds. And cost of living, very inexpensive. It's just a great culture. It doesn't look like California, but it's if you're a business owner and you're trying to figure out a way to give people good wages and affordable quality of life, it's a great place to be. And that obviously carries over the population growth and the income growth carries over into the multifamily world, and so that's what we've really seen. And people get here and they're like, wait a minute, I can get a tenant that's not paying rent out in 3 weeks and for $150. I mean, that's night and day. I mean, we hear stories of people paying $50,000 for somebody to go away, in other states, just because they could be in that unit for a couple years without being able to get out. So yeah, that's really appealing for people as they're coming here for the first time.
So kind of the theme of the evolution of the workforce housing space, who was buying the first deals from you in 2004, 2005? Maybe talk about 7-8 years ago, kind of who was buying that, and then who's our market participants today, and how's that kind of changed or evolved over the last 15, 16 years of career?
Yeah, it's an interesting question. It's as I was just looking at some data prepping for our time together today. A lot of those buyers back then, it was not unusual at all for us to see a California buyer who we'd never heard of before, and maybe a 1031 buyer. Maybe someone who, just sold a duplex or fourplex and was going to try to move that money into something bigger. And
they sell a duplex in California, buy a 50-unit deal for you.
Right. That's right. That's exactly right. Even one of my good clients now, who I'm doing a transaction with right now, I mean, they used to buy small deals here, and now they've sold a lot of the smaller ones and have transitioned that into larger assets over time. So I think that was the type of profile. We had a couple of regional type operators that owned a few deals in DFW back then as well. But in general, of course, our clients were certainly more private back then. I mean, we still have a lot of those clients today, but some of the bigger, more regional type players. But it was a lot more people that were spending maybe their own money at the time, and that has evolved over the years. We had a period where, you'd see more syndicators come into the market. And then here in the last maybe 5, 6, 7, 8 years, the rise of kind of the local investor and the local investment groups who are pooling money together, and some of the different educational programs that are out there, that's led to a massive increase in the local buyers, being the ultimate winner, even on not on a $5 million deal, $10 million deal. I mean, they're winning $25, $30 million deals and on up from that even.
And are we seeing like foreign buyers coming to buy Dallas Fort Worth workforce housing? Was that ever a thing? Someone from Japan buying a deal 15 years ago?
Yeah, we have sold in 15 years ago. No, we weren't seeing a lot of that. I would say certainly in the last 5 to 8 years, definitely seeing far more of that. We've sold a number of deals to Japanese investors.
Yep.
We've certainly had some Middle East funds that have been placed over here, Canadian funds as well. That's and our firm specifically has really made a significant inroads into Canada and opened up a number of offices there, and so that's definitely led to more eyeballs on inventory down here. So yeah, I mean, definitely, I wouldn't say that's who we expect the buyer to be, but we have some good contacts and good clients on the international front, and occasionally they'll call and say, "Hey, I need a deal," and we kind of know what they're looking for, and have had some good success in putting them into some of these type of deals.
As kind of wrap this part of the conversation up, are we still seeing a lot of California 1031 buyers like we did 12, 13 years ago before everything blew up?
Yeah, I mean, I would say in general the answer has been no, but I will say specifically with Marcus and Millichap, I think we probably see more of it than anybody else does. Our firm was based in California,
Right.
founded in California. We have a number of offices in California and a huge sales force out there. And the way our corporate culture works is really a culture of information sharing. So, we had a deal that fell out when COVID first hit and the world shut down. And two of our top guys in the firm, who happened to be in our Palo Alto office, called and said, "Hey, we've got a high net worth client of ours who really wants to move money to Texas." And they ended up, coming in and buying a $39 million deal with a line of credit. I mean,
Right.
yeah. And then we had another guy in our Seattle office that called and said, "Hey, I got a 1031 guy, doesn't want to be in Seattle, would love to kind of get money in Texas." He ended up buying another deal of ours. So we do see more of it probably than I would say that the DFW as a whole sees.
Yeah.
But that's not who we necessarily expect to be our buyer. We do have another deal actually, as we're talking about it, that's getting ready to close here in the next 2 weeks. That's also a 1031 buyer out of Utah. So it's out there, but not necessarily
Half the market like it was 12 years ago.
Not like it was then. Yeah, I mean, that was kind of the expectation. So we'll get a 1031 buyer. And a lot of times, really thinking back to 2004, 2005, 2006, we weren't really doing call for offers dates then, and we weren't. Everything had a price on it then.
Yeah.
So it's a very different time now than it was then. Whereas, hey, we want X dollars for this deal. Well, I'm a 1031 buyer. Yeah, I'll pay X for it. And there was no date that we were building up to. So those deals were a little easier to do.
Sure.
You always have the timing issues with a 1031 now. And so those are just a little more tricky and challenging if the timeline doesn't line up perfectly.
So one of the things I know we've talked about several times in the past is really kind of the cap rate compression that we've seen quite a bit, where the property grades from the A to the C used to be 300 basis points or more from the Class A to Class C. You would get maybe an 8 cap or better on a Class C deal, maybe a Class A deal was a 5 cap, and now everything's pretty much on top of each other. And we talked about the evolution of kind of some of these investment clubs and the amount of capital these guys can raise. One of the things we've talked about in the past is kind of you have some of these like annuity deals where you've sold the same deal 3, 4, 5 times. I know you sold the Azul in Northeast Dallas County over there, Northeast Dallas kind of Lake Highlands area. And then I noticed right now you guys currently have a listing Diamond Lock out in North Richland Hills.
That's right.
And this is probably your 3rd or 4th time selling it?
Yeah, it is.
So I thought maybe we gotta kind of go through the evolution of maybe that deal. Diamond Lock's probably a pretty good example. Maybe talk a little bit about that deal, kind of the stats of it, and when did you first sell it? When have you sold it again? And kind of what are we anticipating this thing about to go for right now?
Yeah. Well, Diamond Lock's a fun example because that was literally the first ever 100+ unit deal that I ever sold in my career.
Okay.
So, and so we sold that deal in January of 2005. So I'm 6-7 months into the business at that point. January of 2005, we sold that deal for $32 a door. I went back this morning and looked at our old underwriting, which that's a whole nother conversation. But
a little bit different
it's
now.
a little bit different now. And a couple things I was really looking for is what was the average rent on the rent roll, and that was let's see, $695 was the average rent.
$700.
$700. And these are big units, right? So that was pretty low. And then the debt is the other thing I was looking for.
Yeah.
We underwrote 6.8%.
Okay.
No IO.
Okay.
And 75% LTV.
Okay.
So
that would have been a bank loan most likely.
It was probably LaSalle. At the time that was kind of a lot of people's go-to lender. But anyway, I mean dramatic difference. I remember that being a pretty desirable deal at the time. Nothing like what we'd see today, but it sold. And then years later, fast forward, I think 7 years. Let's see. Yeah, January of 12.
Okay, 7 years later.
Okay, so that deal sold for $45,000 a door.
Okay.
So nice, I mean,
about a third up.
Nice gain, the average rents weren't that much higher. They were $730 at that point in time. The debt that we underwrote was better, 5.3% interest, no IO, right? So again, nice gain, better financing, slightly higher income, buyers made money. Well, fast forward to, 2020, whisper on that deal is probably 137-ish a door.
Wow.
Maybe goes a little higher than that. It's in better condition in 2020 than it was in 2005. Certainly the units are much nicer. The exterior, everything about it is much nicer. And the area is every bit as good, if not better than it was back then. Average rents now are $1,200.
Okay.
Right. So almost double, not quite double, but some of the floor plans are double. And then the debt is 2.8, 2.9% with
IO.
with multiple years of IO. So that's the formula, and that's a pretty good picture of how the market has changed over time. Dallas back in, remember my talk track in 04, 05 is, well, you don't come to Dallas for appreciation, you come here for cash flow.
That's right.
Right? These California people flocking here, they got appreciation out there, but they didn't make any money. So here you come to Dallas, you made your money out there, now come here and put it to work and make cash flow. Obviously, now here you're getting appreciation, but you're also getting cash flow because the debt's so good. So that's what's really driven it. I mean, if your debt was 6.8%, what kind of cap rate would you have to buy the deal at for the math to work?
Probably a 10 or
right.
better.
I mean, they're deals that we underwrote in the 9.5, 10 cap range back then.
Yeah, because if you're seven amortizing, I mean, your debt constant, 9.
Yeah. I mean, it's not a lot of positive leverage there. So yeah, I mean, obviously 2.9% with IO and much higher rents is, you're probably making more money on it today than you were then, even though your basis is
100,000 more.
Yeah, 100,000 more a unit.
I think that really perfectly encapsulates what's happened in your and my career. That,
totally.
That was a local guy who sold it to probably some 1031 California buyer in 2005. I don't know that, but I'm assuming it was probably that was the scenario. Who had some duplex or a 10-unit building or something in Huntington Beach, California, wanted to come to Dallas for the yield, and went from a 5 cap to a 10 cap back in 2005. And generally the workforce housing market, broadly speaking, rents have doubled and prices have tripled. And a lot of this is debt driven. That's really driving it down. And I don't know if you have a different opinion, but I mean, I don't think the consensus certainly is, and I don't think anyone really has an opinion that the interest rates are really going to go up. If anything, I mean, the last 12 months, we've seen interest rates go down, right?
Yeah.
I mean, the debt's much more attractive. What was like a typical debt term a year ago on something you were selling?
Well, I mean, yeah, it probably the same or higher. Yeah. Maybe sub 4, but somewhere around there. And I mean, I can remember the first time that somebody locked a rate in years ago, and it was like 4.8. I'm like, oh my goodness, I can't believe you got an interest rate that starts with a 4. I mean, I just thought that was mind blowing, right? I mean, but when I started, it was sub 7, right? So it's dramatically different on that front. But
so what I'm thinking is going to happen is, right now we've seen prices kind of basically stay flat throughout the year. We haven't seen too much movement one way or another. Maybe generally pricing kind of going up a little bit, but it's generally pricing is pretty similar to what we were a year ago. But the interest rates are down, 25, 30% from where they were. So I think we're starting to see these prices kind of creep up. So one or two things are going to have to happen, because we just bought a brand new Class A deal, Nick, that we got, pushing 80% leverage on a 2016, 2018 vintage deal. When's the last time you've seen 80% leverage on an 80s deal, let alone on a brand new construction deal? So that tells me one or two things has to happen. Either interest rates have to go up, which I don't think anyone thinks, or cap rates have to go down. I mean, that's kind of what I think is going to happen in the future. Any thoughts or comments on that?
No, I 100% agree. We used to do, for our Marcus Millichap conference every year, we do a survey, and it was basically one of the questions on that survey was, what do you think the biggest risk is in the DFW multifamily industry right now? And the interest rates, property taxes, expenses rising, payroll, and every year interest rates rising was always runaway choice for everybody's biggest concern, and that has shifted entirely. I mean, that wouldn't even that may be the lowest thing chosen if you were to take that survey today. It was the last year we did it. It was certainly not the winner, but yeah, I think there's far more concern about a lot of these other areas and variables in the multifamily space right now.
I'll bring this chart up that I've seen recently, where it was like what actual interest rates did, and then at the same time it kind of showed what expectations were. And you kind of see this chart kind of goes up and down, but generally speaking, the interest rates are going down, and the forward expectations at the time always tails up. It's just amazing to think that we've been thinking for the last, the entire time you and I have been in this business, that rates are going to go up, and they just never do anything but go down. It's just been crazy. It's really the evolution. So maybe kind of as we kind of get towards the end of the conversation here, maybe we can start talking about some actual practical things. That's what I always like to try to leave viewers of the show with is, what are some of the mistakes that you're seeing potential buyers when they're underwriting these deals? What mistakes, in your estimation, if they do make them, what do they kind of center around? Maybe one or two things.
Yeah, well, I mean, I think the obvious one is undercapitalizing the deal up front, especially if you're in the B or C world. A deals maybe less so, but the reality is when you get 2 or 3 years in and realize, man, I really wish I had this money to do this, you'd have been so much better off just getting that money at the beginning. It's so much harder to go back afterwards and do that. And so I would, without question, that's the number one mistake that I see over and over again. The second one, which is probably 1B, is putting the wrong type of debt on it. And I know you know this. I've done this. I've done this myself as well. And I have a front row seat to watching people make this screw up all the time. But I'll just put it this way: I don't know anybody that's put a floating rate loan on a deal that's like, I wish I wouldn't have done that. And the good news is I feel like people have wised up, but I think so many people think, well, I'm going to be it's easy to do a 12-year or 10-year. I'm going to be a long-term holder. And then they don't realize after 3 or 4 years, well, man, we're crushing our expectations. Maybe we ought to take advantage of this market. And then they're stuck. You can't do it. And I mean, in this market, in the last few months, the deals that we've had that have been offered all cash, new financing, have been off the charts, record breaking in terms of the activity on it. The deals that are assumptions people will look at, but the dramatic difference in activity and ultimately pricing is, I mean, you can't ignore it. So I would say, matching the debt, and if people believe what we're talking about here, that the rates are not going to rise, you put a cap on it, float it, and give yourself all that flexibility, and you will not regret it. And then I would say just one third thing is not managing the equity expectations properly, overpromising returns, putting a pressure on the property and the management that doesn't need to be there. The reality is, as hot as the market's been, if you buy a good asset, operate it well, I would say most people have a reversion cap rate that's higher than what they ultimately end up selling it for. And so the deal is going to work, and it's going to work out well, and people are making money unless they're just stressed their model so much at the beginning that they've set themselves back before they've even started the process. So those would be 3 things that I would say to really kind of focus on. And if everybody did that, I think they'd be in a pretty good place.
What's your what's got you losing a little bit of sleep, if there's anything? What's the biggest risk to our market in your estimation right now?
I mean, I would say I don't see a lot of risk. I feel very fortunate to be here. I mean, obviously the values are inflated, and and I'd say inflated relative to maybe historic, performance or whatever. Cap rates are lower, values are higher. I mean, I illustrated that with the history
But
of
the
that
rents are
deal.
there.
But the rents are there, the performance is there. So I would just say, getting to the point where too many people maybe are uncomfortable, maybe would be a risk. I think for us, being in secondary markets, and that's why we've invested so heavily in those markets, to just give people an alternative. Hey, if we're to the point where we're just uncomfortable in Dallas, and I don't see this as being the opportunity that I want it to be, maybe I'm not making as much yield as I would like to make, even if my overall returns are there. We have other options where you can get that yield. But I feel really fortunate. I think the population is going to keep growing. I think the business climate is fantastic here, and I don't anticipate that changing. We've still got plenty of land.
That's right.
And the developers are still
Keep building.
throwing up. And if you really want to get into the specifics, building costs are not going down.
No.
And in fact, quite the opposite has happened during COVID with the supply chain issues all over the world right now. Building costs are very high. Lumber's very high. It's hard to get appliances. I mean, you could go down the entire construction materials list, and in order for those deals to work, they got to charge really high rents.
Yep.
And that's only a good thing for Class B and C property owners, because as that gap increases, that's where we can keep pushing rents up, and
and drag the workforce housing up with the institutional product.
Yep.
What risks do you hear from your clients that people are worrying about that you think that they shouldn't, that they're kind of fears misplaced?
I think there's a lot of people who've been around this market for a long time, and they think I can't buy right now. How many times in the last 5 years I'm waiting for the market to reset? Right. Well, if there was ever going to be a reset, I think we just went through it, and we're already out the other side of it. And I don't want to say it's totally behind us, but in spite of all this, I mean, we will be up over last year in terms of what we do, both on a number of deals, on a volume, every way we could measure it, we're up. And with our team growth, we're going to be up again next year. So despite the world shutting down, not just some sort of event in the U.S. or whatever, or a local event that caused, I think we've come out, and the fundamentals are still there, and they're still strong. So I think for people that are sitting on the sidelines saying, hey, I'm waiting for a reset, I'm waiting for values to go down, I think you may be waiting a while. And so you either adjust to the times. The equity is adjusted, certainly. I mean, people were wanting a 2x, and maybe now they're happy for a 1.8, and that's fine, right? I mean, there's money to be made there. And then for folks that don't like that, look in other markets, look in other opportunities, because they're out there. I mean, some of the craziest deals we've seen this year are in some secondary markets, and I would be happy to tell folks if they want to contact me about some of those stories. But like, we just sold one in an Oklahoma market that their first month of collections, haven't done anything to the property yet, the income was up $17,000.
Oh wow.
1 month.
Yeah.
From basically high 70s to mid 90s 1 month.
Yeah.
So just with better management, better team on site. So you're more likely to find some of that kind of stuff in some of these other markets. You're not likely to find something that's just been grossly mismanaged in DFW. Not to say it's impossible, but it's a lot less likely. So
maybe kind of last question before we wrap up here. What separates, in your estimation, you observe a lot of different operators out there. You've done 500 plus transactions at this point. What separates the better multifamily operators or owners or investment groups versus the ones that tend to struggle or fail?
Well, I would say attention to detail is huge in my mind, and it's hard to. I think it's almost a trait. well, I got to be thoughtful with how I say this. My kids don't have great attention to detail all the time. I still have hope for them, but I was going to say, I guess by the time you get to be 25, 30 years old, if you don't have it, the odds that you ever do have it are probably not great. Hopefully that's not the case for our children. But if an on-site manager doesn't care, that I don't think your property is not going to do well. So if your management company can create a culture where they're not just, hey, it's hard to find a maintenance guy, so we're going to just live with this maintenance guy that's not great, or it's hard to find a new manager, or this manager's not making that much money, so this will help us meet our budget if we keep this person, but they're not that great. Like, if you're willing to settle for not that great, then you're going to get not that great results. And so there's some companies that their culture is so great, and people are genuinely proud and enthusiastic to be a part of that. And I just feel like that flows through the P&Ls. Right. You walk by a little piece of trash and you pick it up, right? Or you've been on plenty of property tours where people just walk right by it and pretend like they don't see it, right? So I think that's a big deal. And from an owner operator standpoint, right? Are you a part of that, right? And when you go to your property, do you see and observe that? And is the expectation being met? And what does your model unit look like? What do your laundry rooms look like? And these are just simple, quick eyeball test things. You could dig into the GL and you could see, are we paying our vendors on time? And you can look at a lot of different factors like that. But at the end of the day, that culture of, do I want to be a part of this? And am I proud to be a part of this? I think that's what truly separates the people, because guess what? The big owners out there, and you would be included in that group, you don't hear about, oh man, they just totally laid an egg on that deal. No, because you have a culture, you know what you're doing, you're not making those mistakes that I talked about earlier. And then when it comes to operating, you're thorough and you have an expectation, and it's a high, and so I think that's important, and it's not easy to achieve. If it were easy, everybody would do it, right? So I think that's probably what I would say more than anything else.
Well, Nick, appreciate your time today. People want to find out more information. You guys, if anyone's out there looking to buy multifamily workforce housing in particular in Texas and North Texas, secondary markets, Dallas-Fort Worth, Nick sells almost as much as anyone in town. What's the best way for people to get more information about you guys? Yeah,
the quickest way that somebody could reach us would be on our website, multifamilyadvisors.com. We do text alerts, which I think is really effective. It's easy to miss emails. So if you want to sign up for our text alerts, you could certainly do that on the website as well. And you could reach out to me directly. You could reach out to me, and I can put you in touch with some of the other guys on our team. If there's a specific market or a specific property type you're interested in, I think that'd be fantastic. I would tell people that maybe are watching this or listening and say, man, how do I even get started? Call us and look at our 75 unit and under stuff. That's the whole idea behind that, is to get your feet wet, and then you can grow into to being a bigger, more sophisticated investor. So we'd love to help in any way possible.
So Nick, appreciate it so much. So for Nick Fluellen and Michael Becker signing off. See you guys next week.
Follow the Multifamily Investing Show on Facebook, YouTube, LinkedIn, and your other favorite podcast platforms. To learn more information about investing with Michael, please go to www.multifamilyinvestingshow.com.